investors often use recent market data to make long-term investment decisions. They give more importance to these recent events and conveniently ignore the more weight-bearing serious data of the past. The investor behavior in Yes Bank in around 2018-19 is a classic example. The bank price collapsed around 88% thanks to the governance issue with the bank. But around October 2019, there was a mild recovery in the bank and investors rushed to go long. Now, despite focusing on the fundamental news and information of the stock, what investors were focusing on was the short-term price action. And this is recency bias in action. Recency bias happens when you give more importance to those recent events rather than focusing on the bigger picture. Here's an example. Suppose you are comparing two mutual funds, Fund A and Fund B, and their returns look something like this. If I ask a new investor which fund are they going to choose, they would probably choose Fund A because of the recent stellar returns that Fund A has generated. They might say that there is going to be a turnaround in Fund A. What they are ignoring is the past performance of both the funds. And this also is recency bias. The human brain is wired to recall the recent events, and that is why we overestimate their importance and underestimate the past data. It's a natural tendency, but this can lead to bad decisions while investing. Let me share a couple of personal examples to help you understand the impact of this bias. Number one, whenever my father wants to make an investment, he generally has a long-term thesis attached to it. He believes that the stock can give him a good return over the period of 5 to 10 years. But in the period of, let's say, 2 to 3 months, if the stock is able to deliver 20 to 30%, he would go ahead and sell that stock. Later on, when the stock would continue to grow further, he will have an immediate regret of why he sold the stock earlier. Now, this is recency bias, focusing on the short-term price movement and forgetting the long-term thesis. The next example is about my college senior to whom I motivated to start investing. He agreed as well, but the only problem was at the time he started his investment journey, the markets were near all-time high. And eventually, after a couple of weeks, the markets dipped. Now, he was getting anxious that maybe markets are not for him. He is making those losses at the time and the entire portfolio was in red. Now, what he was focusing on, the short-term dip that the market has seen, but what he was ignoring was all the past historical returns the market has given over the period of time. When you act on recency bias, you are essentially letting those short-term movements overshadow your long-term goals. And that is when the real damage happens. So how do you protect yourself from this? Number one is to broaden your horizon. Do not only look for those recent market events, but also analyze those past historical data that will help you make better investment decisions. Number two is evaluate across time periods. Don't only look at 1-year returns, but also lay focus on 3-year and 5-year returns in order to ensure consistency in a particular stock or a fund. Number three is understand cycles. Markets and business go through cycles. If there is a bull market, eventually will come the bear market and vice versa. Where do you stand in this market will help you frame your strategy better. And number four is stick to your financial goal. Define what is your short-term, medium-term or long-term financial goals and stick to it. That will help you to avoid all this market noise. And lastly, before you invest, just ask yourself this one question. Am I focusing too much on what just happened? I hope you like this video. See you in the next one. Till then, happy investing.